So let's begin. Good morning, everyone, and thank you very much for joining us in the inaugural charla sponsored by HHF, Hispanic Heritage Foundation, and REAL, the Real Estate Association of Latinx Professionals, both very instrumental organizations in championing the advancement of the Latinx community across multiple areas. My name is Ada Arevalo, and I'm the founding chair of REAL, as well as the founder and CEO of impact Capital, a gender lens investment platform focused on affordable, sustainable, and equitable real estate investments. It is my privilege to be moderating this conversation with you today, and I have some of the top Latinx leaders and innovators presenting across multiple real estate sectors. Would love to give them an opportunity to introduce themselves. Ladies first, of course, Geraldine and Stacy.
Sure, I'll start. Hello, everyone. This is Geraldines Advice. I work at JLL, and I am the Global Head of Research for the Hotels team. In my role at JLL, I also lead the Living Research across the Americas platform. Thanks for having me today. I'm really excited to share my thoughts on the industry.
Welcome, Geraldine. Stacy?
Thank you, Ada. So glad to be here. It's an exciting time with a lot of uncertainty right now in commercial real estate. My background is a chief investment officer, and I'm a former trustee of CalPERS, institutional investor in this space, and also a board director for KBRA.
And now let's go with our gentlemen joining us today. In no particular order, Manuel.
Hi, I'm Emmanuel Martin. I'm the head of retail in Wing. We probably are the third largest owner in the world of retail, so we're managing more than 500 assets worldwide, and I'm based in Florida. So pleased to be here today with you all.
Welcome, welcome. Arturo?
Good morning, Ada. Good to be here with everybody. Arturo Snyder, CEO of Prime Store. Excited to share some thoughts and ideas here based in Los Angeles, California. Great to be here with all of you.
Thank you and welcome. Antonio?
Thanks, Ada. It's a pleasure to be with everyone. Antonio Marquez, founder and managing partner of Comunidad Partners. We are a real estate private equity fund manager, really at the nexus of affordable workforce housing, ESG, DEI, and prop tech, just really trying to transform communities and enrich lives and driving better impact outcomes. So it's great to be here and fantastic to be with such an esteemed panel here. So thanks for having me.
Thank you and welcome. Now, just a housekeeping item before we begin the charla. If you have any questions, please feel free to post them on the chat. We will review the chat periodically and try to get to as many questions as we can within the conversation. So as we begin the conversation, I want to start by acknowledging the fact that we are 2 years into a global pandemic that really transformed our industry, right, across many sectors and in many ways. So from a macro level, what can we expect, or what are you expecting in your specific sectors in 2022? What are some of the challenges, some of the opportunities, and just some of the overall direction of your sector? And I would like to open that up, and we can start with Antonio, since you were the last to introduce yourself.
Pick on me because I was last. No, but this I mean, I think as we look into 2022, there's a lot of challenges from the last 2 years that have just been carried forward. We're in multifamily, so the challenges in our particular industry can be unique, some on a macro basis of just, getting through COVID, getting through the challenges of how to function and operate and interact, as people, is one that is still, very much kind of alive and well, despite, some normalization. But from a capital markets perspective, we're seeing a lot of challenges around just interest rates right now, and trying to get a sense of just the market. Pricing discovery is something that is really at the top of our mind as we're trying to make sense of what's happening in the market and what that's ultimately going to do to valuations and just investment activity as a whole. And then, more specifically in our asset class, we had an eviction moratorium that lasted for almost 2 years. Although eviction moratorium was lifted in September of last year, we're still seeing some of the residual effects of that. And at Comunidad, really, our strategy is really preserving home and really enabling our families to live in their home and providing for shelter for their families. So eviction was always a last resort, but there still are some lingering effects. And given our knee-jerk reaction isn't to evict, we're still trying to work with folks that are still trying to get back to normal, getting jobs and that sort of thing. So that's a little bit more specific to kind of our strategy. But there's a number of facets, a number of challenges, but at the same time, I think I'm very bullish on the future, particularly the long-term future. Some of this stuff will abate. There are some areas that I think we're looking at that will kind of change the landscape from an operational perspective and capital markets perspective. A lot more impact capital coming into our space, which I think is really helpful to supporting the communities that we serve. But certainly new challenges and new opportunities that come with that.
The story of our lives for the last 2 years. So here I am talking about how COVID has transformed our industry. It has definitely transformed our technology when we can't even get ourselves off mute half the time. And I'm just speaking for myself on that. So thank you. I want to pass the opportunity to Arturo, because Arturo, Prime Store historically focused on community retail, especially in Latino communities, but more recently, we've seen Prime Store include or integrate the residential piece into community retail. What is your 22 outlook based on your investment strategy?
Yeah, thank God. I think, for us, we have been pushing in many cities and jurisdictions here in Southern California to get the mixed use zoning going, and to really open up the mentality that we've got some of the densest communities in the country, and yet we had the zoning that really didn't allow for that integrated, well-planned use. Now that we're developing the massive infrastructure of the subway, metro systems, and really connecting the city and the region together, we've got a lot of community support as well as leadership to put us in a position to do these urban high-density mixed uses. So retail, commercial, medical office, maybe some limited service hotel facilities supporting a community town center that really is a live, work, play environment. And in the Latino communities, we haven't seen that. So I think our biggest sort of outlooks for 2022 is getting through a pretty significant pipeline of entitlements. We're breaking ground on a big project in a couple of weeks, and then it just rolls for the next 4 or 5 years. We've got a fairly robust integrated use, affordable housing, market rate housing, to create mixed income communities in Latino neighborhoods that offer opportunities for entrepreneurship and business ownership that is owned. And also for us, it's all about local hiring, construction jobs. Everything we do is local hire. We force our retailers to hire locally, and we manage the metrics around that. So like Antonio, I do think there's some pressure points in the market, some supply constraints that we're going to have to deal with and adjust to. We do all of our underwriting unlevered, so debt is not something that is a solve for us. We use debt when it is something that is accretive, and if it happens to be that it isn't, we just don't play in that space. So we try to be completely agnostic to that. That's kind of where I see things going in the near term.
That's a great point. Thank you, Arturo. So Manuel, I'm gonna reach out to you, sticking to the retail part of the conversation. What did you see? Well, we know what we saw in the last 2 years with the global pandemic. How is retail adapting and changing to the new era, the post-pandemic approach?
Yeah, that's a great point. And I think retail, before the pandemic, probably you all remember, everybody was talking about the retail apocalypse. And then we get into the pandemic, which was like when you are dying and you get the last shot. What's happening now is very interesting because actually we're seeing a slight decline for the first time in many years of e-commerce and a jump in physical sales. And this is because people are tired, right? People really want to go and interact, in the shop. And we see that people are trying to find the things that are scarce in a world dominated by technology. And this is food and beverage. These are services, convenience, okay? Neighborhood, as Arturo was putting it. So we are seeing a strong market in leasing in all what is necessity-based retail and neighborhood retail. We are seeing that anything without a roof is trading well. Actually, I was with a broker yesterday, and he was saying, hey, this is a seller market now. So be careful what you are doing, okay? So open air is evolving well, right? And then we see other sectors. We see in many cases cap rates, which are really, really keen, okay? And in a growing interest world, we're gonna see, I think, these cap rates correcting very fast as soon as the rents start to decline. Okay, if you start renewing leases in industrial buildings and the rents turn negative, the cap rates are gonna get corrected. Okay, so everybody in the capital market and all the investors are talking about the spread between retail and other sectors, and that's the big question: when is gonna be the inflection point there? Because currently there are 300 to 100 bips in many retail propositions which are working perfectly fine, like grocery anchor, like lifestyle, mixed use. So I think there is a big reckoning, no, in the investment community that not all retail is bad. Okay, and challenges the year ahead. I would say malls will remain challenged, especially the ones with high basis. Okay, then the major problem of malls is the basis. People pay for them, the rental level, and this will continue correcting. Okay, as we stay over densified in the US, oversupplied, and we still have the department store as backbone of the malls, and the department store is a business model which is I don't want to say broken, but not far, right? In many cases.
Yeah, it's not necessarily working at its best.
Ada, if I can echo what Manuel said. We've got 2019 sales occupancy is higher than pre-pandemic for us, and the traffic is very strong. And as Manuel mentioned, leasing activity is very, very robust. So we've got a lot of activity there where, because we're in this emerging market within the United States and we're under everything, under retailed, under supplied, under housed, under health, under whatever you want to call it, but over on capacity, talent, and people, it's a great cross section to be in.
That's a great point. And you know what? Continuing the conversation on two sectors that were significantly challenged, aside from retail, and definitely retail being one of them, Manuel, Geraldine, hospitality was thought to, possibly be extinct by the time we come out of this pandemic. How has hospitality adapted, and what are they seeing in 2022? What can we expect as far as a comeback, for a lack of a better term?
Right. No, it's a fantastic point that you make, Ava. In terms of industries that really depend on the mobility of people, right? Retail and hospitality being that, we were crushed during 2020. But what we saw in 2021 is that we were a resilient bunch, right? And so with governments and lenders being very accommodative and vaccination rates really increasing, and honestly, people just growing tired of being home, we saw lodging demand reach really unexpected levels in 2021 that we just did not see coming. And so the industry is making great strides in a positive direction, but we are not out of the weeds. And so in 2022, what we expect to see is more of that demand recovering, but it truly being uneven, right? It really is a story of two tales where leisure markets, less dense markets are definitely benefiting from more of that leisure demand, as business demand and group demand has been slower to return for a lot of different reasons, right? COVID being the main one, and just gathering groups being not as agreeable with many state restrictions, right? Or country restrictions. So we continue to monitor that evolution of demand and also see the emergence of what we're coining as leisure demand, right? Which is basically a blend of business travel and leisure travel. With people now having more flexible working arrangements and not being tied down to the office 5 days a week, you know, it'll become easier to add a leisure component to business travel. So that will all bode really well for the industry and helping diversify that demand profile. From an operational perspective, you know, there has been significant growth in occupancy, ADR, and revenue per available room, but there's still some challenges, right? In terms of profitability, there's still many hotels that are not turning a profit. And a lot of that has to do with operational expenses, right? And with inflation, labor challenges, and supply chain issues, which we've all kind of had to face in one way or another, there's definitely downward pressure on profits. And so that's something else that as an industry we'll have to monitor very closely, and think of creative ways to solve some of those issues. And then lastly, just from an ESG and DEI perspective, I think the hotel industry this year will definitely be faced with more concrete steps in the right direction, from a sustainability perspective, right? And coming up with solutions to help advance ESG goals, and also being able to tie returns to different initiatives. And then probably most importantly, our industry has also always been very good at keeping the guest top of mind, but the employee experience hasn't always been that front and center. And what COVID has shown us is that people need more than monetary compensation to feel motivated to come back to work and to feel proud of the roles that they fulfill. And, you know, the hospitality industry at the operational level employs a lot of minorities, and we need to provide programming, childcare, and other solutions that will help people return back to the workforce and also lead better lives. So it's a transformational period that the industry is going through, but it's also very exciting because the goal would be to get back, not to get back to 2019, but to get back to a better period of time, right? And truly revolutionize the industry.
Thank you. You bring up an excellent point, and I'm gonna call on Stacy on something, because unfortunately 2020 brought forth a lot more than just a global pandemic. It also brought forth unfortunate disparities that as a country we've been dealing with for centuries. And so I want to ask you, Stacy, with all of your experience and from a capital allocator perspective, what can we expect in 2022 as it relates to institutional allocators helping to bridge that gap that has become even more evident, you know, since the pandemic?
That's a great question, Ada. And I think these points are all connected that the panelists are bringing up when it comes to like everything from commercial mortgage-backed securities to what's happening with growth and valuation in underserved areas. So I think there are a lot of institutional investors right now who are looking at commercial real estate and understand that there is some risk right now in this uncertain market. So they're starting to look at undervalued areas, and those undervalued areas are our communities. So it's undercapitalized, diverse communities. That's also where we're seeing unrest because there's higher unemployment, historical discrimination. And so if we start to see more commercial real estate investment in those areas, that will, of course, create more jobs. There's a great economic multiplier there, but then also allow more companies to locate there and really build infrastructure, economic infrastructure that is critical to a community's growth. So I think there's an opportunity to look at the dislocation in this market that's been created by COVID and a variety of other factors and use it to invest. And so with Build Back Better, with the reallocation of a lot of just capital that's on the sidelines right now, I think we're going to see much more funding go to those areas.
Thank you. And we sure hope so. And as a matter of fact, Antonio, and I know he's going to be modest about this, but I would like you to talk about the institutional funds you just raised, because to your point, Stacy, we are seeing the institutional capital flow into the organizations that are driving that change.
Yeah, and I think Stacy's spot on in terms of where the void exists in the marketplace. And even as I found in Comunidad, it was really to really kind of support and even embrace and ultimately put in our work into action from my heritage and my father. My father was he was a Mexican immigrant, and he was a farm worker, and ultimately started a company out of his garage and turned that into the largest distributorship of Hispanic grocery products. So if anybody's familiar with El Mexicano, he started that brand. So being raised in that environment, working in diverse Latino underserved communities, going to tienditas and mom and pops and trying to sell abarrotes and that sort of thing, just kind of understanding the challenges and how underinvested they were, really gave me a different vantage point and a different lens in terms of where those disparities existed, where the disconnects were, and what was really needed, from an investment perspective into those neighborhoods and communities. And so that's been kind of our guiding light, our mission since our inception. It's just a way for us to pay it forward and to support and elevate these communities and hopefully give them an opportunity that my father never had. He didn't speak English. He had no more than a 5th grade education. And so we've been fortunate enough to have a great track record investing in workforce housing in diverse neighborhoods. It wasn't called workforce housing back then. It was just an afterthought. It was really kind of the lost child of the multifamily industry, but now it's gotten a lot more attention. And because we've been able to demonstrate that it is a viable investment strategy that can generate attractive risk-adjusted returns, and been able to bust the myths or really reverse some of the misconceptions of these neighborhoods, more capital has flowed to them as more information, as more data, as we've been able to demonstrate proof of concept around it. So as Ada mentioned, we decided to raise a fund with the strategy to really scale our impact and try and touch and improve more communities. And it was a long process. It was an arduous process. We had never done it before, but we had great advisors and a great management team. And I think just the culture and the aspect of these neighborhoods are vibrant. There's a tremendous amount of untapped potential, and activating those communities through capital that's done in a meaningful, thoughtful way could really drive returns. And it's almost kind of a holistic approach where we're driving returns into the communities. We're supporting residents through investing in them through our social impact practices. And it's truly a way where it's highly complementary, and there's a symbiotic relationship between resident, community, and ultimately investors, where we had to reimagine that value proposition and do it in a space that was really kind of opaque and again, overlooked and certainly underinvested. So we were able to raise enough money for us to continue our work over the next 2 years and hopefully continue our impact and scale it.
Absolutely. Thank you, Antonio. Along those lines, Arturo, I know that we've talked about some of the challenges. Prime Store is one of the largest, if not the largest, Latino owned and led organization with your specific strategy. What are some of the challenges that you continue to see as you continue to grow the brand and continue to make an impact on the communities that you focus on?
Yeah, I mean, I think I echo Antonio's comments in terms of capital being a critical element of this. I think as we've grown the strategy and now you have a 30+ year track record of execution and a market or above market returns, it is always shocking to me that we're still in that space of, well, you're still considered an emerging manager or you're kind of just getting warmed up. And I'm thinking the person asking these questions is 20 years younger than me and probably doesn't know much about real estate or development to begin with, let alone anything about our underserved communities. And so our team, which is really comprised of folks from the neighborhood that have a passion and a drive to do that, I think for us, what we see is with disbelief that in 2022, we have these kinds of obstacles, because whenever you speak of impact, when you ever speak about ESG, people wear the hat of, okay, so how much money am I losing for this? And because the concept of charity has become this sort of feel-good environment of, well, we do that. We as an institution, we invest in high return places, developing projects that frankly don't move the needle that much for the community they do it in. And we give money away to the people that, and you fill in the blank to be politically correct. I think the issue is that in our spaces, you can be transformational, and capital needs to rethink that charity only exists because of mistakes that have been made in the past. And if we all work hard at elevating and raising all boats in the tide, which is our primary obligation and the passion of the firm, is capital is the last missing piece, because talent, passion, like Antonio and his father and the, people that we work with and the millions of people that we've impacted, they got more passion and drive than you could ever need. And they love their community. They love being there. They want to stay there, and they want to be given a reason to be there and to bring their talents to bear. And I think that is still the most complex thing to see, that our IRRs are above market, but we're still this, brushstroke of, probably driven by, being a minority or being in a space that is less than the mainstream, if you will.
Absolutely. I mean, as much as I would like to think that we've made great strides on those issues, we're still so far behind as a community across all markets and all sectors. Manuel, as an asset allocator, let me ask you, Nuveen is one of the largest, and I'm speaking off the top of my head here, so, fact check me if you will. I mean, they manage about $3 trillion for organizations such as TIA. Mm-hmm. How does Nuveen ensure that they're generating returns for their investors, but that they're also being as equitable as possible in the allocation of the capital?
Meaning equitable, meaning that they favor all sectors or the ESG?
From an ESG, well, so both from a DEI perspective, so being a partner with diverse retailers in your specific sector, or implementing ESG strategies that bring along DEI.
Yeah, got it. Thank you. So yeah, Nuveen is, by the way, $1.3 trillion, and real estate is around.
I was way off.
Yeah, well, not too far. And then real estate, I think the latest is $150 billion, right? So we are around the #4 manager in the globe. ESG is super important, right? And I think, generally speaking, as a citizen, I think it's not the government, it's us, right? When I say us, I mean us, and I mean our employer, and I mean, you know, our tenants, and all the chain, right? And it's proven that climate change is an investment risk. So climate risk is an investment risk. And the only way building up resilient portfolios and enhance long-term returns is with ESG, right? And Nuveen, broadly speaking, we have a net zero carbon goal for 2040, right? And in the day-to-day, this is already happening. So we are going through a lot of buildings and assessing how they're exposed to climate. And now, since this year, every time we're bringing an opportunity, when we are starting the due diligence, we need to have a report on climate impact, okay? I'm not saying we're not gonna do Miami waterfront. I'm saying that we need to have a climate report, and we need to have clearly, crystal clear, what's gonna be the impact and the remedy cost, so that investors are making an informed decision, right? And these are, I mean, I can't be talking here. I tell you, we have a lot of this going on, but is somewhere where Nuveen is you know, in the vanguard with other in the industry, with others.
No, absolutely. And from what I know from Nuveen too, they're definitely a leader in the affordable housing space, trying to lead the ESG initiatives that you just mentioned.
Yeah, affordable impact investment is something we are very bullish. In Germany, we have a fund up and running. We're trying to launch one here. We have a program with TIA Bank giving mortgages to single mothers, and that's happening for many years now. So it's a company where this is, you know, part of the DNA, and something you can be proud of. And then diversity, I think it's a booster for productivity. When diversity is consistent across the board, and you go of all levels, in all levels of the organization, you give opportunities to all the talent, you know. I think productivity, you know, gets better over time, is proved.
Absolutely, with diversity of thought and diversity in general. Could not agree with you more. There's a great question. So I'm going to pose that to Stacy. Actually, I'm going to pose it to everyone in the panel, because this has been top of mind in the CRE industry as a whole, with institutional capital moving a lot more into the residential rental space. And I think there's a big, there's two sides of the aisle, right? There's the institutional side that says that, well, we want to give families more space, so we want to be able to own, you know, the 2-3 bedroom homes that could house larger families, where the other side of the panel is very concerned that institutional capital taking over residential rental can actually hinder first-time buyers' ability to acquire a home when, you know, the entry price point has already skyrocketed. So what do you think? And I would like to start with Stacy on your thoughts of institutional capital moving into the residential rental space.
Thank you, Ada. And I think what we've seen with that recently, particularly, for example, Invitation Homes going in, buying up large blocks of residential real estate, actually shows the opportunity in diverse areas, right? So clearly there's an opportunity there. It's one that's often not categorized correctly by investors. So investment policy statements might look at commercial real estate, for example, and give it a certain rating, not looking at things across the board, like in terms of holding all else equal, what the bond rating would be for that particular municipality and investing there. And so Invitation Homes has been pretty smart in going in and buying up this real estate. Now, does it create challenges for affordability going forward? Absolutely. But this should signal to investors that these markets are ripe for investment. And if there is such a disconnect in terms of where our investment dollars are going, we might need to rethink our investment policies. So I know when I used to lead COIN, which is the impact investment fund for the insurance industry, it was about $29 billion. We would look at bond ratings for certain areas, whether or not a school had free or reduced priced lunches. And if there were, for example, safe and sound ratings across the board and similar yields, we would invest in a low income and diverse area first. That is the area of growth. That is the area of need. And so again, I think companies like Invitation Homes are seeing that. So what my hope is that other investors wake up, see this opportunity, and have a different approach. So provide more affordable capital so that developers can go in and create new housing there. Or that we look at different types of mortgage programs so that more people can buy homes and we can all build wealth together.
I could not agree with you more. Anybody else would like to chime in on their opinion?
I think it's very controversial, right? I think it's tricky. We are also investing in single family homes, and we are seeing the prices growing and the rents growing, no? And we always wonder what's going to happen when interest rates go up and this market start going down, because the valuation of residential sometimes is not a cash flow, right? Is the comp analysis. So people don't find the connection between the two valuation methodologies, but I think there is a connection. I think the market tends to get everything aligned. And then the second consideration is if we are talking about inequality, you know, and trying to build a better world, and we see this rental growth, the rental growth across the board, there is a regulatory risk here attached to these investments, because at some point, you know, politicians and government will try to make things better, you know. So it's really concerning in the long term, and I think it's getting to a pricing is getting to a point where you really need to start considering, is this going on for too long, you know?
It's crazy, especially in, you know, the two coasts. Antonio, what do you think?
No, I think Manuel brings up a very good point. I mean, it is one of the unintended consequences. You know, as Arturo was talking about earlier, we're just under-resourced, you know, as a country, and housing is one of the, you know, where we have one of the greatest needs. And so because of that, if you think of community and you think of hierarchy of needs, just shelter, housing, and that sort of thing, when there's a disconnect behind, you know, one of the most essential needs of people and families, what happens is the unintended consequences of some of the civil unrest that we're seeing. So I think in terms of the single family play, the build for rent play, there's definitely a need, but we need to think thoughtfully over the long term in terms of how that is applied in the communities. How does it really satisfy really kind of the idiosyncrasies that occur within those communities, and really trying to mitigate some of the unintended consequences in terms of the regulatory risks that exist. Because although in multifamily right now we're experiencing very robust rent growth, and you know, there is kind of a bias towards multifamily in the capital markets because of that rent growth. That comes at the expense of families and households and affordability, right? For them to live their lives, to provide for their families and that sort of thing. And of course, you know, it's a market, you know, system. But at the same time, I think we need to find offsetting factors of supply, of support, you know, to families, of better resources. Again, this is where kind of the S of the ESG comes into play in terms of social impact. You know, at Comunidad, what we try and do is look at housing as a vehicle for change, or a vehicle of opportunity for our residents. So really trying to provide them, you know, better, you know, health access for health equity, you know, for instance. So we rolled out a virtual healthcare program. better education, opportunities, after school programs or ESL or GED programs, and even just jobs, so economic advancement, to allow residents to have more durable jobs, more higher paying jobs. And again, it's kind of an ecosystem approach. I don't think there's one solution. It's going to be kind of a multifaceted approach, and we just need to be thoughtful. But I think more importantly, kind of committed to that over the long term, or else, to what Manuel was saying and Arturo earlier, and even Stacy, is that things can get really bad, especially over the long term, if we don't take action to really support the communities that are in need of the work that we do and the capital that's necessary to get that work done.
Yeah, I think one of the things that I concur with, and we're working on correcting the course of history here, because one of the things that we're seeing is really the strategy has not been about improving the quality of our communities and our people's lives by improving their revenue and their income. It was by producing cheaper goods so that they would falsely be able to buy more with less. And at the end of the day, that's been catching up to us, right? So that globalization strategy is basically what used to cost you $25 to buy a pair of shoes because they were handmade or somewhere near you, and the person making them were making a good return, a living wage. Now today, you buy them for $2 and you're excited about it, but you don't realize the impact of that. And I think what we're focused on as the next iteration of our business is that business ownership, and then the way that companies promote our communities from within, so that they get higher paying jobs and higher positions of decision making capacity within the organization that is connected to the outcome. Because that, as Manuel said, diversity is an absolute asset, and I think it makes companies wiser, but it also makes them much more aware of how broad the impact has to be, so that you go out and gather the entire neighborhood as part of your growth strategy, and not siphon it off to a certain demographic profile. And so that is, I think, business ownership is another key iteration of that, and you've got to start hiring, but also promoting and being very strong about creating talent within our industry and those industries we touch.
Yeah, and I'd be interested to get Stacy and Geraldine's thoughts on this, but I think, to add on to what Arturo was saying is, diversity, and there's, a host of data that supports the thesis that diversity, equity, inclusion actually drives better business performance, business results. And there's a whole host of data that, I'm happy to share, and I'm sure HFF and Real can share. But I think the key is not just only diversity, equity, inclusion within organizational structure, but getting diverse talent and leaders into those decision-making roles, as Arturo was saying, because until we get that, we're really not going to be able to move the needle, and frankly, have the kind of understanding, the cultural understanding of what these communities need. So we're big advocates of representative management. Diversity is a strength, and not forcing diversity as just an initiative or just to make a company's website look better, but really because it's having transformative changes in terms of how things are done at the local level, and even national level. And we are seeing a little bit more of that, but it's something that we need to continue to work on, because we're just not there yet in terms of diversity, in terms of boards and leadership positions across the commercial real estate industry.
Antonio, to piggyback off of what you're saying, actually 2 points related to the single family rental space and the flurry of institutional capital entering the space. If I switch to my living hat, it is a concern, and it's something that I am monitoring right now. It's a concern because rents are going up, right? And so if this was supposed to represent a more affordable option for individuals, in actuality, it is not. And so if that's only exacerbating the affordability issue market by market, it may get to a point where more local governments are implementing rent controls, and we're seeing some of that emerge across California and the Northwest, St. Paul, Minnesota as well. And so that then deters construction, right, from happening in those markets, which then only, creates an issue with supply, which then only drives up rents. So it definitely will take a holistic approach. It's not an easy solution, but at least we're having the conversation and can all come together to come up with a better solution. So those are my thoughts on the single family rental space. And then when it comes to diversity, and I track this on the hospitality side a lot too, and as it relates to public companies, right? The Castell Project, which is an organization that kind of tracks diversity and inclusion in the hospitality space, did a study in 2019, I want to say, or 2020, and they looked at 31 public hospitality companies. And out of those 31 companies and 31 CEOs, one of them was Black, one of them was Asian, and one of them was a woman. So clearly there's a huge issue. There are no Latinos. And that not only the only issue, the main issue being is that, kind of to a point I alluded earlier, the main workforce within the hotel space, right? The people that are delivering that service, that are executing on strategies, tend to be diverse people, but they're being execute strategies that are created by a majority that is not representative of them. And so there's this huge disconnect and a great opportunity for the industry as a whole, right? Where we need more Black, Brown, Latinos, women at these leadership positions to create strategies that make sense at the operational level.
On that point, Geraldine, while we have you kind of on the spotlight, one of the things that became popular throughout the pandemic, and I'm not certain if JLL is executing on this strategy, but there's been some conversion of hospitality or hotels into affordable housing. That's your area of expertise. What have you seen? Have you seen that gain more momentum? Is that soon to become a new asset class, or has it start kind of winding down as we start seeing the light at the end of the tunnel with the pandemic?
It's definitely something that even before the pandemic would happen, but in very specific markets, right? So think New York, San Francisco, LA, and it definitely increased throughout the pandemic, but we've started seeing that dwindle down a bit. That being said, there are a lot of hotels that unfortunately, just because maybe they're too old or the owners can't hold on to it, will have to be turned into another real estate use. And so it will be really up to the local governments to come up with a scheme that will allow for these hotels to turn into affordable housing. But again, I think that's where the partnership between public and private organizations could be improved, and for local governments to make that process a bit more easy, right? And not be so bureaucratic and so, I mean, we think about how some of these local governments work, they're less than efficient. And so again, there's room for opportunity there because there is some product within the hotel space that will grow obsolete. Couple that with the pandemic issues, and that will provide a good source, right, to turn into affordable housing. But again, I see that mostly happening across those coastal markets where affordability is even a bigger issue, right?
Gotcha. That's a great point. I want to touch on a question that they brought up. Brenda Sanchez brought up a question saying, where can we learn about real estate investing? We absolutely think it's important to invest in underserved communities, but how do we change the mindset from trying to get rich to making a difference in our communities? And so the reason why I wanted to bring out this question as a whole is because I think previous generations were raised just socially to think of wealth creation irrespective of unintended consequences, right? To the points that Arturo talked about. I am so proud of the newer generations. I mean, I'm a millennial, but the newer generations are really pushing for meaning with investment, returns, everything. Investments are no longer just about returns. They're about people, purpose, planet, and profit. How can a younger professional start learning about the type of ESG investments that we are all in? What would you say? Don't all jump in at once.
That's such a layered question, but such a good one, frankly. And I'm looking at the chat. I think there's also questions around how can we get involved? How can we get engaged? How can we, raise capital and also be a decision maker? And I think, just like anything else, there aren't any shortcuts to life. I started Comunidad on my kitchen counter. And it was just a lot of hard work. I didn't have a track record, but I had I had a vision. I knew my community. I had a story and a strategy that I was really passionate about. And it was just building relationships, coming to events like this, being active, being engaged, having a thirst for knowledge. There's some other questions in terms of what are the resources. And I think it's constant gardening. And it's a commitment to that process of, really building a company or investing or working for a company that you are really aligned with, that has purpose and meaning, right? But more specifically, around ESG. Our ESG, we didn't start our company with ESG as a strategy. We just did it because it was who we were. It was a part of our ethos. It was part of our DNA. I mean, some of the, like the after school programs or the ESL, it's just, again, my father didn't speak English, and that was a problem, in those neighborhoods. So it was a solution that was close to me and near and dear to me. And we did it because we thought that it would just, support residents, and it was the right thing to do. We also did it because we thought we would build loyalty along the way. So I think it's just being authentic, having an intention, being committed to it, and coming to events like these and just staying at it. I guess one other question was the question around syndication.
Antonio, if I can touch briefly on what you said
Yeah.
on the topic of hiring and bringing opportunities, because I think that one of the things that happens also in corporations, companies like yourself, when you're already at a position where you're bringing people into the workforce and you're bringing them into the industry, is that the mainstream market has sort of also dictated the filter by which you look at people. And you say sort of like, okay, so I'm looking for, right? And you're looking for these things that, okay, college degree, where did you come from? What's your background? And I think the talent pool of this next generation that Ada was mentioning is also very open to a very different way of growing and engaging. And as you make hiring decisions, promotion decisions, it is also about taking the glasses that have been put on you off and saying, no, I'm going to look at things the way the future looks at things, the way we look forward at things. People that have passion, drive, initiative, a willingness to learn, a commitment, and giving them the opportunity, opening doors to them, giving them an opportunity to grow. And I learned, I didn't go to college, and I learned the business on the street and rolling up the sleeves and going into the work hands-on. And that was an incredible college for me, an incredible education for me. And I think that we got to give that opportunity as well to our community, because we're coming from a system that didn't necessarily open the doors for them to go through that mainstream path, but we still want them to have incredible success and growth within their own communities. So, changing that filter, I think, is critical in hiring and promoting, and being more open-minded about where talent comes from and how it's defined.
Thank you. That's a great point. Manuel, Geraldine, or Stacy that would like to add to that?
No, nothing to add. I think Antonio and Arturo made great points. I would say that anybody wanting to get into a sector, and ESG is like another sector, right? Or industry or trend is what I say to my team. Everything is about transpiration. I mean, you need to work hard, right? To get there and learn and network and put hours and eventually work in a company which is in that trend, right?
I would add that it's really important to invest in the area that you come from, especially if it's an underserved area. So I have a lot of family in Fresno in the Central Valley, and I joke that I summered there, which if anybody's familiar with the area, it's like 110 degrees, but I'm still very committed to that area and try to bring partners together to invest in that area. And so for somebody who's just starting in this space, there are opportunities in undervalued areas where you can bring partners together and buy commercial real estate. So you can go to LoopNet, you can go to CityFeet, you can look at a city's economic development website and understand the incentives for buying in that area. There are ways to start to structure this. And it's important that we understand our power individually, but also collectively, because ultimately we're the asset owners. When we talk about an insurance company, a bank, an investment fund, and the retirement space, those are all holdings of individuals. So what if we started to demand reinvestment in our areas or allocation that matched the need and the returns? It's something for us to really think about when it comes to understanding our role.
That's inspirational. Thank you, Stacey. Geraldine, if there's anything you would like to add?
No, I mean, my panelists here have covered it all. I would say if you're getting started in the industry and you're young, and be curious, read articles. That way, if you know your stuff, no one ever has to question why you're seated at the table, right? And so I would give that advice to just the newer up and coming generation. Just make sure you're crossing your T's and dotting your I's, making sure you have the knowledge, and then be proud of who you are and speak up, right? Because you're there for a reason and someone wants to hear what you have to say.
Absolutely. And with a minute left, I want to thank all of our panelists for joining us. Greatly appreciate your insight. And I want to leave all of our audience with something very, very important. We all started somewhere. We didn't become executives, from one day to another. We all did exactly what Geraldine just talked about. We asked questions, we met the right people, we participated in events. Be present. Real is launching their mentor initiative. That's a huge opportunity to connect with other Latinx executives and to get training and mentorship from them. Be engaged, be present, and together we can change the world. Thanks everyone for joining us.